This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street for Tuesday, November 4th, 2014, Election Day in the United States. This program was recorded at approximately 4:40 p.m. New York time. The market closed down a little bit today, right on a trend line coming off the October 23rd area, extending through the last couple of lows. Market bounced off that trend line early in the day and held above the line all day. We'll take a little look at the technicals a little bit later to see how the market outlook is shaping up. I'll also talk to you a little bit about my take on what elections mean to the market in general. And we'll look at some of the news that people are talking about this week, including the Bank of Japan's action to increase its money printing and support of the markets, as well as what's going on with the Fed and some of the sham operations that it is undertaking to supposedly mop up some of the excess liquidity on its balance sheet. So today is election day, and the question is often asked, what difference is that going to make? What difference will it make in particular that the Republicans are about to take control of the U.S. Congress completely? They already control the House, and it looks like they're going to attain a majority in the U.S. Senate. But unlike parliamentary democracies where the winning party controls the government, not only the legislative process but also the executive, in the United States the minority can still have not only influence but a certain degree of control. And that happens if one party or another does not have a supermajority, 60-vote majority in the U.S. Senate. And it doesn't look like the Republicans will attain that. So for all practical purposes, I don't think much is going to change. The Democrats will be able to pretty much stymie any legislation that the Republicans want to pass in the Senate. And of course, President Obama is likely to veto anything he doesn't like. There may be a few things that they get through, but these will be marginal changes. And ultimately, I don't think the political process has much impact on the markets one way or the other. Republicans like to think that Democratic policies are bad for the market, but traditionally, historically, the U.S. stock markets have done better under Democratic administrations than under Republicans. Go figure. The real impact of the market is based upon, of course, as you know, my opinion is that it's based upon the liquidity flows that are coming out of the central bank. And we've seen some big changes here in the last few months as the Fed has ended quantitative easing. Going forward, it's only going to be purchasing enough mortgage-backed securities to replace those that are being paid down from its balance sheet every month. It won't be purchasing any more Treasury securities or additional MBS. So essentially, the Fed's balance sheet is now going to stay flat. But they'll still be pumping a little bit of cash into the primary dealer trading accounts every month. In addition to that, we got this blockbuster news from the Bank of Japan that it's going to increase its quantitative easing, and the Japanese government pension fund also plans to buy $150 billion in foreign stocks. To some extent, the Fed ending QE is going to be replaced by these additional operations by the Bank of Japan. We also know that the ECB is going to attempt to purchase more securities. So far, their operations have been basically a drop in the bucket. Hasn't been enough to reverse the negative trend in their balance sheet, but they're going to keep trying, and maybe they'll have some success with some new programs down the line. It's too early to say. But for now, the Bank of Japan will be pumping in enough cash, and the slight amount of cash that the Fed will be pumping in via its replacement purchases of MBS will also have some impact. So there will be some cash flowing into the system. The Fed renewed its term deposit facility in recent weeks, starting out with about $110 billion taken by the banks. And that has increased this week to a rather immense $262 billion taken down this Monday by the banks. In addition, the Fed announced that it's going to add to its reverse repo operations another $300 billion in term repos for 1 week terms. That'll start pretty soon, and that'll increase the total amount of the reverse repo program to $600 billion by the time all those weekly repos are out and floating about. Right now, the overnight repo limit is about $300 billion. If you add to that the $300 billion in reverse repos and the 200 and some billion right now in the term deposits, that moves over $500 billion off of excess reserves, what's called excess reserves, into other accounts on the Fed's balance sheet. In addition, the $300 billion that's coming in term repos could eventually increase this amount to $1 trillion. So the purists, the economic purists, will look at that and say, well, the Fed is reducing excess reserves. But in fact, the practical impact of this will be nil, because the Fed will merely be exchanging one kind of liability, which is the bank's direct deposits, which is like their checking accounts at the Fed, for another liability, a 7-day term deposit or a reverse repo of 1 day or 7 days. This cash will still be in the banking system. The banks will still have access to this cash. Some of it may be on a delayed basis of up to a week, but for all intents and purposes, that doesn't make any difference to them. They still have access to the cash. They can still use that cash for whatever they please. So if the Fed thinks, and if the market observers, the people who watch the Fed and the pundits on CNBC think that by moving this money around on the Fed's balance sheet and technically taking it out of the classification of excess reserves and putting it into some other classification is going to change anything, I think they're going to be sadly disappointed. I frankly don't see how waving a magic wand and changing the category of a liability is going to change the amount of excess cash in the system. And with that excess cash in the system, I don't see how the Fed is going to materially achieve an increase in interest rates. Now look, if the Fed is paying 26 basis points on this $300 billion that could be in term deposits, that effectively reduces the bank's cost of funds. It's a subsidy to the banks. So if the bank's cost of funds is subsidized, why would they increase rates? They have too much cash to begin with. They're going to want to compete to make loans in this environment of a, quote, growing U.S. economy. So if the Fed is subsidizing their loan rates, in my mind, that's going to merely keep rates low and push them even lower at the retail end of things. So to me, it remains to be seen how the Fed is ever going to achieve an increase in interest rates with these excess reserves. If the law of supply still applies, the first step in increasing the cost of money is to reduce the supply of excess cash in the system. And the Fed is certainly not going to take any steps in that direction for the foreseeable future. So with the Bank of Japan's surprise announcement last week that it was going to increase its purchases under its own quantitative easing program, I began to wonder, in this era of endless central bank liquidity that we've been in since 2009, is a major bear market in U.S. stocks even possible? After all, the central banks are playing this game where they're either all pumping together or they're taking turns maintaining a certain level of increase in the worldwide pool of liquidity, so that this pool of liquidity never stops growing, never shrinks, and essentially is always on extremely high a path of growth relative to past history. We are really in uncharted waters here. They've never done this before. So the policy change that the BOJ announced was that it would increase its asset purchases from around $70 billion per month in US dollar equivalent terms to around $85 billion or so. So that doesn't sound like a lot, $15 billion. But simultaneously, Japan's massive public pension fund said it would buy more stocks and fewer Japan government bonds. Specifically, the pension fund will buy approximately 150 to 160 billion of foreign stocks over an unspecified time. So apparently the BOJ will buy bonds. I sound like the apparently kid. Apparently the BOJ will buy bonds from the pension fund, financing the fund's effort to acquire more stocks. The BOJ is directly printing money to buy stocks. So the 15 billion, even though it's only a $15 billion increase in the amount of outright purchases, that's going to be hot money flowing directly into the U.S. stock market. When Japan says it's going to buy foreign stocks, you better believe that the bulk of those are going to be U.S. stocks. So that is going to be very high-powered money in terms of the U.S. market. Now here's what the Japanese, the Bank of Japan balance sheet has looked like on this chart, where we look at the three major central banks, the ECB in blue, the BOJ in magenta, and the Fed in green. The line for the Fed is going to turn flat. It's going to hold its balance sheet flat by purchasing mortgage-backed securities to replace the ones that get paid off every month. So those purchases will inject some cash, say around $15 billion a month, into the accounts of primary dealers, but the Fed's balance sheet will stay flat. Meanwhile, the Bank of Japan is going to be continuing to print at an angle similar to or slightly greater than this angle of the past 2 years. So that's going to add to market liquidity. The wild card is the ECB. So far, its newly announced programs have been unsuccessful in growing the ECB balance sheet. They may be successful in arresting the decline in the balance sheet. We've discussed the particulars of how the mechanics of the ECB are different from the Fed and the BOJ. They don't. Most of their funding has been through voluntary loan programs. And now that the ECB is charging interest on the deposits that it holds, many of the banks are trying to pay down those deposits. So that's causing the ECB balance sheet to shrink. The new purchase programs that the ECB announced is an attempt to offset that. But it remains to be seen if they're going to be successful in growing the balance sheet. So the total line up here, the total of the three central banks added together in US dollar terms, has only had a couple of minor declines. One at the beginning of 2013, it didn't amount to much, and a slightly larger one back in 2010 when the Fed was in a pause and the ECB and the BOJ balance sheets were shrinking a little, and that was associated with a pretty good sized correction here in 2010. But by and large, we can expect this line to continue to grow at a moderate pace. It may not grow as fast as it did through here because the Fed and the BOJ were both pumping simultaneously, but it will continue to grow at a modest rate up here. Now, we've seen for the past 5.5 years that the S&P 500 has tended to mimic the total growth of the world's three major central banks. And I don't see any reason why that wouldn't continue into 2015. As this line continues to rise at a modest pace next year, then we could probably see the S&P 500 trading in a range of, say, 1,900 to 2,100 or maybe 2,150 or so throughout the year. I don't see the basis for a bear market. But I was curious as to what the last bear market looked like in terms of these central bank balance sheets. So let's go back and take a look at that. Now this chart is a chart of the Fed, the BOJ, and the ECB's assets from 2003 to 2009. So this is the period of the last bull market that we had in the S&P and the last bear market from the top in 2007 to the November 2008 low. I won't get into 2009 because that's where things started to turn around and these central banks started pumping furiously. And it changed the scale of this chart radically. These lines looked a lot smaller from 2003 to 2009 on that chart. But it's not the total size that counts. It's the direction that I'm most interested in to see what happened here in 2008 that caused this bear market. Now, if you look at the total line again of the three balance sheets, you see that in 2006, there was a decline in the total assets of the Fed, BOJ, and ECB balance sheet. Now, that happened because the Bank of Japan shrank its balance sheet by approximately 25% in a very short period of time here in 2006. As a result, the world's liquidity pool shrank, and that resulted in a 10% correction in the S&P 500. Doesn't look like much, but at that time, I mean, how many 10% corrections have we seen? Keep in mind, the Fed was still increasing its balance sheet size by about a rate of about 5% per year at that point, and the ECB was still growing its balance sheet through that period here. So it was about a 15% drop in the worldwide central bank liquidity pool, and that equated with a 10% correction in the S&P 500. Then the balance sheets remained stable as the Bank of Japan modestly cut the size of its balance sheet over the next year. And the Fed also stopped growing its balance sheet in 2007. That left the ECB alone in growing its balance sheet. And as you can see, what happened here is that the size of the three major balance sheets remained pretty much unchanged from the middle of 2006 until the third quarter of 2007. And that's when the U.S. stock market topped out. Now, of course, the Fed's effect is more direct on U.S. stocks than the effects of the BOJ and the ECB. And when the Fed began to pull money out of its system open market account to fund the alphabet soup programs, the emergency funding programs to try to prop up the financial system, that hurt the primary dealers and that triggered the bear market in U.S. stocks. What happened here when there was such an immense spike in the worldwide liquidity pool? Well, the ECB put its pedal to the metal and instituted a number of massive lending programs to these European banks that were collapsing. Where did all that money go? Well, it's not on this chart, but it went to fund nearly simultaneous rally in the U.S. Treasury market. The ECB increased the size of its balance sheet by about $500 billion in U.S. dollar equivalents. So as a result, that $500 billion was available to fund the U.S. Treasury market, and the worldwide panic that ensued saw most of the funds that were available in the world panic into treasuries. And we saw that big rally in treasuries that was simultaneous with the collapse in U.S. stocks. So the bottom line is that the stock market bear market was related directly to the Fed shrinking the SOMA. So if the Fed isn't likely to shrink the size of its balance sheet anytime soon, and the BOJ seems hell-bent on growing its balance sheet, and the ECB is at least trying to prevent its balance sheet from shrinking and trying to grow its balance sheet, when in the foreseeable future would we see the conditions that would lead to a bear market, where at least one of the world's major central banks is shrinking its balance sheet? Well, we don't see those conditions on the horizon yet, but certainly at some point in 2015 we may. The Bank of Japan may eventually relent from this wild money printing and decide to take a pause. And once it does, if both the Fed and the Bank of Japan are in a pause, we could see a shift of liquidity preference away from U.S. stocks. That's very speculative at this point, and we have to rely on the technical analysis to guide us as to whether or not we're headed in that direction. And last couple weeks ago, when we had that big sell-off, the market came down to this major trend line, made a hot stove touch. This trend line is the parallel of the trend line connecting the highs up here from 2013 through 2014. This line is the parallel, and it extends back to the 2012 lows. So the market came down to this parallel channel line, made a hot stove touch, and the rest is history. We've seen a rapid recovery back to the highs. And this week we touched a trend line that goes back to the early 2014 period and extends through here. We've touched this line. We haven't quite made it to the second trend line connecting the mid-year and September highs, but we're certainly within spitting distance. That would be at around 2040 this week. Now, in order to see another steep correction, I think we've got to break under 2000. And if we do, there's really nothing to prevent the market from going all the way back to make a retest of this trend channel. But the indicators aren't forecasting that. If we look at the momentum indicators, starting with the 10, 12-month cycle momentum, and then looking at the 3-year cycle momentum and the 2-year cycle and the long term, they've all upticked in recent weeks. Again, they came to the brink of breaking prior lows, but they didn't break. So as a result, we've come off those levels. We don't have any real strong definitive buy signals. It looks like they're just going to wiggle back and forth. But until these lines roll over and break these prior lows, I don't think we can settle in for a long-term bear market. For now, I'm going to stick with a call of a trading range, probably topping out at around 2050. Although the cycle projections, some of them point higher, but the proof will be in whether we get through that. If the market does get through the 2050 area, then certainly you can make a run 2175 or 2100, 2150, 2175 or so. But barring a breakout through the 2040, 2050 area, then I think we form another trading range, potentially from around the high 1800s to the mid 2000s. That's what I'd look for over the next several months. So that will do it for today. We will get together again next week on Monday instead of Tuesday. We'll go back to the regular Monday evening posting. Until then, have a great week, trade sane, and I'll see you next Monday.